David Gaud, Fund Manager, Asia ex-Japan at Edmund D. Rothschild Asset Management, joins us on the show right now. David, it's good to have you on the show. First up, really, what is it that you are doing across your investment strategy in Asia?
Well, clearly, I mean, if we're talking about flow globally, there is one key indicator we're considering when investing in various countries in Asia. It's the currency. As we've seen so far this year, we've seen some weakness in some of the currencies across the region. And the most striking case is India. So in that respect, the difficulty for us who are, we are very much bottom-up in our approach. But it's difficult, to pick the best stock in one country while the currency is going significantly against you. So for that reason, we have to be a bit cautious. And so I think, in terms of inflows, outflow, some countries are more affected than others. Hong Kong should be less affected in that regard because it's closely correlated to the US dollar. On the contrary, India, which is a free currency, is facing actually more pressure. And in that regard, we've been relatively cautious on India until recently. But, a cheap currency is also a great opportunity to buy if you actually are able to find out assets which are undervalued. The weak currency actually makes the buy case even stronger. And so for that reason, India is becoming, in our view, more and more of an interesting case at this stage, considering that the currency has come down a lot so far this year.
David, if we talk about large caps, a stock that has been battered the last 3 days is Tata Motors. Not the best of earnings. What's your view on the earnings and an outlook on Tata Motors?
All right, but basically, I mean, the results that came out last night were above expectation at the bottom line. But when you look in details, margin-wise, this is relatively disappointing coming from the Land Rover part of the business where margin have come down. Domestic market was actually doing better than expected, but which means that from a margin expansion point of view, we've probably seen the best for the company. So this is still a company that will continue to deliver good top-line growth, but we're just coming out from an exceptional year in 2012. So 2013, from that point of view, is probably going to be more challenging. From a regional point of view, the stock is not that expensive, but it's no longer cheap. And I think for that reason, is the stock going to continue to outperform massively the India market and the auto space? This is quite questionable. And for that reason, I would turn actually a bit more cautious on the company. The long-term perspective is still very much positive because they are following the footsteps of some very successful story like Toyota in the past, like Hyundai, reducing the number of platforms, focusing on key success models. And they are addressing the global market where demand is still holding relatively well, especially in the emerging world. So I would still hold the stock in a portfolio as a long-term play. But it's true that from a massive overweight, I would probably be more moderate and turn more to a mild overweight on the company.
What about Reliance Industries? Because that's also been a key drag on the market. What's your view on the stock from a near-term and also medium-term perspective?
In the case of Reliance Industries, it's a bit of a structural issue we have with that company. From the first point of view, the downstream business is very much dependent on the global cycle. So you take exposure to this global environment, which we know is not favorable and is difficult to assess what's going to come out for the next 12 months. The second thing is that at the end of the day, the company has disappointed so far in terms of development in the oil upstream space. Reserves have been revised down, and so for that reason, it is difficult to apply a premium for the company. And lastly, and I think this is more from a corporate governance point of view, the company has been investing in non-related segment, which, for us long-term investors makes the case even more complicated and difficult to understand what they're trying to achieve by diversifying into other segments which are absolutely not related to their core business. So considering the very volatile parts between the downstream, uncertainties about the investment case, and a management which is less focused on growing its core assets, I would continue to apply a discount to the company, and I wouldn't expect this company to outperform from a stock and from a stock market point of view in the near future. So we remain extremely cautious on Reliance Industries.
Yes, that's reflected in the way the stock also performed in today's session. Thanks, David, for that.